Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2025, December 25th. Markets are on holiday mode, but the news cycle is fully caffeinated.
Nothing says peace on earth like a $20 billion AI chip headline and gold acting like it just discovered espresso. Let's do the calm, rational thing and talk about it anyway.
Today, Nvidia and Groq. Why this isn't just a flashy deal, Amazon's problem with AI shopping bots, gold punching through new highs, Hong Kong tightening crypto rules, and a quick pulse check on Japan's bond market.
We're doing AI, shopping, shiny metal, crypto cops, and Japan yields. It's like a buffet where every dish is somehow interest rates.
Story 1. Multiple reports say Nvidia is striking a deal with Groq, licensing Groq's technology and hiring top executives. Another headline frames it as Nvidia buying Groq assets for about $20 billion, which would be Nvidia's biggest deal on record if it's structured that way.
So it's either we bought your brain or we rented your brain and also hired the brain's friends. Either way, Nvidia is collecting AI chip infinity stones.
Simple version of the finance. Nvidia's core advantage is supply, ecosystem, and developer lock-in. A move like this is about defending margins and time to market, because in AI compute, being 6 months late can be the difference between pricing power and price cuts.
It's basically like you run the only popular restaurant in town, and a new place opens with faster service. Do you ignore it? No. You either buy their kitchen setup, hire their chef, or at minimum steal their playlist.
Why it matters for normal investors. This reinforces that AI infrastructure is still the profit pool. If Nvidia can absorb challengers' ideas and people, it may extend the AI picks and shovels trade, but it also raises antitrust and integration risk, plus the risk that customers diversify anyway to reduce dependency.
Okay, but while Nvidia is buying shovels, Amazon is looking at AI shopping bots, like, are you a customer or a tiny robot shoplifter with a credit card?
Story 2. Amazon faces a leader's dilemma. Fight AI shopping agents or join them? The concern is agents offering instant checkout, price comparisons, and alternative buying flows that could bypass Amazon's control of the customer journey.
So the bot is like, I found the same blender $12 cheaper, and I already bought it. And Amazon is like, excuse me, I'm the one who does the buying around here.
Finance behind it, if agents commoditize the storefront, the value shifts from owning traffic to winning the fulfillment and platform fee stack. Amazon could respond by building its own agent layer, charging merchants for better agent visibility or tightening policies. Each choice impacts margins and growth.
It's basically like when everyone started using map apps. Gas stations couldn't rely on where on the corner. Now it's where the one the app recommends. Retail is heading there, but with robots that don't impulse buy gum. Gold is acting like the group chat's anxious friend. Did you see the headlines? I'm not saying panic, but I already bought 3 blankets and a medal.
Simple version, gold tends to like 2 things, fear and falling real yields. If investors think inflation stays sticky while rates may come down, the opportunity cost of holding a non-yielding asset drops, and gold becomes more attractive as a hedge.
So if bonds are the responsible grown-up investment, gold is the I don't trust anybody, but I do trust shiny rocks investment. And right now, shiny rocks are winning the argument.
Actionable takeaway. If you're adding gold after a vertical move, size it like insurance, not like a lottery ticket. Decide a target allocation, rebalance instead of chasing, and remember gold can draw down hard when the dollar rips or when real yields rise.
Yes, don't do the thing where you buy at $4,500, tell everyone you're a macro genius, and then panic sell because it dipped $80 while you were brushing your teeth.
Story 4. Hong Kong plans to broaden crypto rules next year with new licensing regimes for virtual asset dealers and custodians. That's a big deal because custody is where a lot of the real risk lives. Hacks, commingling, and the classic, oops, the keys are gone.
Custody is the part where crypto stops being future of finance and becomes who exactly is holding my money and why is their customer support a single email address that never replies?
Finance behind it. Licensing can increase trust and institutional participation, but it can also concentrate the market into a smaller set of approved players. That may reduce some scam risk while potentially raising barriers, fees, and surveillance expectations.
So the trade is fewer sketchy pop-up exchanges, more paperwork, and probably a compliance officer who drinks cold brew and says KYC like it's a personality trait.
Quick story. 5. Japan's 2-year government bond yield rose after weak demand at an auction. Amid speculation, the Bank of Japan may need to raise rates more aggressively to rein in inflation and support the yen. Auctions are like sentiment tests. If buyers demand a better deal, yields move.
So investors showed up and said, I love your bond, but I'm not paying full price. And Japan's yield went, fine, I'll get taller.
Let's stitch today together. AI infrastructure consolidation is heating up. Nvidia wants to stay the default compute layer. Commerce is facing agent disruption. Whoever owns checkout may own margins. Gold is pricing uncertainty and easier policy. Crypto regulation is shifting from hype to plumbing. And Japan reminds us rates can surprise even when everyone's watching the Fed.
My personal takeaway, 2026 might be the year your portfolio needs both a helmet and a spreadsheet. Also, if your AI agent starts buying gold, check your settings.
If this helped, subscribe to BD Daily Finance News Podcast. Leave a comment. Are you more bullish on AI infrastructure, or do you think margins compress as competition and regulation catch up? We'll see you next episode.
And if you're listening on a holiday, enjoy it. Markets will be here tomorrow, waiting to stress us out again. Bye.